Friends, thank you for tuning in once again. I'm your lecturer, Mr. Spotter Fred. And remember, we are still doing our tutorials for advanced financial reporting. This is a paper that's done in the highest level of Certified Public Accountants, CPA Section 6, Part 3, Section 6. And we have been doing from the previous lessons or sessions, we have been looking at topic 3. We had done topic 1, topic 2, now we are doing topic 3. So in topic 3, we have been looking at the topic 3, that is assets and liabilities. Assets and liabilities. Assets and liabilities. From the previous sessions, we started with the assets held for sale, assets held for sale. Then we also looked at impairment of assets, impairment of assets. Then we have exploration of mineral resources. Then we have financial instruments. Then we have taxes, accounting for taxes. Then we have employment benefits. Remember, this is in respect to IFRS 5, and we have already done that. This is IS 36. We have done that. So this is what we want to do now. And this is IFRS 6. This is IS 32, 39, and IFRS 7 and 9. So this one, we have to do it now. Then taxes, that is IS 12. We have not done that. Then employment benefits, IS 19. We have not done that. So we want to, because exploration of mineral resources is not that long, we'll want to combine it with financial instruments. Then we do taxes, then we do employment benefits. So we'll want to do in this session, we'll want to look at the two, C and D, that's exploration of mineral resources and financial instruments. So we want to look at the IFRS 6. Now friends, when it comes to the IFRS 6, we are looking at the mineral resources. How do we account for them? How do we impair? How we test for impairment? How do we recognize? So the most important here is what are the provisions? Yeah? The provisions for recognition. We want to, how do we recognize them in the accounting? The presentation. We also want to look at other presentation. Measurement. We'll want to look at measurement. Then we also want to look at other items like disclosure requirements. So it's not a big deal. We are able to deal with this and then move on to financial instruments. So we are saying when it comes to the assets used in exploring and evaluating mineral resources, that's IFRS number 6, explorations and evaluations of mineral resources. It's just explorations and evaluation of mineral resources. Exploration and evaluation of mineral resources. In paragraph 1 of IFRS number 6, the standard lists the main objective as to it recommends the accounting treatment of assets that are used in exploring mineral resources, as they have slight different purpose as compared with other property, plant, and equipment and intangible assets. However, an entity can still apply the requirement of IS 16 or IS 38. Remember, IS 16 is for property, plant, and equipment, while IS 38 is for intangible assets. That means, friends, that the entity can recognize these exploration and evaluation of mineral resources under the provisions of IFRS 6, but can also adopt the provisions of IS 16, that's the property, plant, equipment, and the provisions of IS 38, that's intangible assets. Now, IFRS 6 permits an entity to develop an accounting policy for exploration and evaluation of assets without specifically considering the requirements of paragraph 11 and paragraph 12 of IS 8. That's the accounting policies, changes in accounting estimates, and errors. IFRS 6 requires entities recognizing exploration and evaluation assets to perform an impairment test on those assets when facts and circumstances suggest that carrying amount of the assets may exceed their recoverable amount. IFRS 6 varies the recognition of impairment from that in IS 36, impairment of assets, but measures the impairment in accordance with the standard once the impairment is identified. IFRS 6 requires disclosure of information that identifies and explains the amounts recognized in its financial statements arising from the exploration for and evaluation of mineral resources, including Roman 1, its accounting policies for exploration and evaluation expenditures, including the recognition of exploration and evaluation assets. Roman 2, the amounts of assets, liabilities, income and expense, and operating and investing cash flows arising from the exploration for and evaluation of mineral resources. Now, in summary, 1. An entity is permitted to develop its accounting policy for exploration and evaluation assets under IFRS without specifically taking into account provisions of paragraph 11 and 12 of IS 8. Then 2. Requires an impairment test when there is an indication that the carrying amount of exploration and evaluation assets exceed recoverable amount. 3. Allows impairment to be assessed at a level higher than the cash generating unit under IS 36, but measures impairment in accordance with IS 36 once it's assessed. So that is just the summarized IFRS 6, and we may not really need so much. Without forgetting, there is impairment element for IFRS 6. So those impairment need to be tested, almost similar to what we did in IS number 36. Now, for that, we are through with this exploration. We are through with exploration of mineral resources. And now we'll want to introduce financial instruments. So we want to talk about financial instruments. Financial instruments. That is IS 32, IS 39, IFRS 7, and IFRS 9. So those are the items that we'll be looking at. Financial instruments. We'll talk of IS 32. That is the financial liabilities. The recognition of these IS 32. We have IS 39. IS 39 is the categories or classification of financial instruments. IFRS 7 is the disclosure requirements. IFRS 9 is to replace IS 39. So IFRS 9 is to replace IS 39, but the project is not yet complete. The project of IFRS 9 is not yet complete, most likely to be fully issued come 2018, but this so far we are dealing with partial implementation of IFRS number 9, which talks about categories of financial instruments. Now first, before we even forget, apart from what we have in our study text manifested publishers, apart from that, you know, when you say financial instruments, financial instrument is a means, yeah, in a layman's understanding, financial instruments is a means of raising funds from lenders. This whereby we issue a financial instrument in order to raise funds. Now the lender becomes it becomes an asset to the lender and becomes a liability to the issuer. So we issue financial instrument to raise money. So that's a layman's understanding. Now, in accounting from the standard definition, a financial instrument is a contract. A financial instrument is a contract that gives rise to a financial asset and a financial liability. Now, it's a financial asset to the lender, and a financial liability to the issuer. That is a financial instrument. Now another issue will come in. What is this financial asset and what is the financial liability? These are some of the definitions which have been recognized under IS 32. So remember, a financial asset is a right to receive cash or equity instrument of another entity. While a financial liability is an obligation to deliver cash or equity instrument to another entity. So that is a summarized definitions of financial instruments. Now, it should also be remembered that when you talk of IS 32, we are looking at the presentation. IS 32 is the presentation of financial instruments. When we talk of IS number 39 is a classification of financial instruments. Talk of IFRS 7 is the disclosure requirements. Then we talk of IFRS 9. This is a classification of financial instruments. As we say, this one is to be replaced, I-39 is to be replaced by IFRS 9. We have examples of financial instruments, and basically we look at the financial assets. An example for financial asset is the trade receivables. We have options, we have the shares. We also have examples of financial liabilities, trade payables, debenture loans, payable, redeemable preference shares, and what have you. So those are the examples. And I-32 makes it clear that the following items are non-financial instruments: physical assets, prepaid expenses, and liabilities. So very importantly, what I was saying here is that when you talk of examples of assets, when you say the examples of financial assets, let me say example of financial assets will be, there is options, there is shares, there is trade receivables, etc. Then examples of financial liabilities, we have the trade payables, we have the bonds, we have debentures, we have the redeemable preference shares, etc. This is according to IS-32. Those are the examples. And remember, prepayments, physical assets are not financial instruments. So don't forget that. We say not physical assets, prepaid expenses, accrued income, etc. are not financial assets nor liabilities. That is important and very important to note. Now we want to look at financial I-32, the presentation of financial instrument. Now, in this case, we'll want to look at just a financial liability. We'll start with the example of a financial liability. How do we recognize that? Example of a financial liability. Now, when it comes to financial liability, then we need to determine the finance costs. We need to determine the amount to be reported in the statement of financial position as a liability at the end of every year. That is an example. We'll want to look at an example on that. And this is the example that we are going to use. The example we are going to use: a company invests 5,000 shillings in 10% loan notes. The loan notes are repayable at a premium of after 3 years. The effective rate of interest is 12%. The company intends to collect the contractual cash flows. The contractual cash flows, which consist solely of repayments of interest and capital, and have therefore chosen to record the financial liability at amortized cost. What amounts required? What amounts will be shown in the financial statements, that is, in the statement of profit or loss and the statement of financial position for the 3 years, year 1 to 3. Now, that's an example that we will want to look at that. An example, let's look at the features of that example. The features of the example. The features of the example, we have 5,000, we have loan note. It's a 10% loan note, 10% loan note, 10% loan note of shillings 5,000 was issued. It was issued, let me just say even it was issued in first issued EG, issued EG on 1st January 2017. Maturity period is 3 years. It means it will mature in 2019. Fine. Then we have also been told that the effective interest rate for this is 12%. Then we also have we have been told the repayment period. They intends to collect the contractual cash flows, which consists only on repayments of interest and capital. So repayment, we are to pay, if you are to pay in 3 years, then the amount that we should be paying is definitely the 500 shillings. So we have an example of the amount to be paid. Amount to be paid annually is shillings 500. That's the 500 to be paid every year, 500, 500, 500. Fine. Now what do we do here? You need to remember that 10% is a coupon rate. 10% is a coupon rate. And this coupon rate will be used to determine the amount to be paid every year, because if you take 10% by 5,000 is actually the 500 that we should pay every year. So the amount payable, if you are not given this, for example, if you are not given that item, if you are not given, then you know that amount to be paid annually could be, you take the coupon rate, you multiply by the 5,000. So I mean the par value. Let me say the par value. Par value, which is 5,000, and that will give you 500 shillings every year. I'm using 5,000. I could even say 5,000 M, so that it looks a good figure. These figures are normally bigger, so we use M. That's 5,000 million. Then you also need to remember the finance costs. The finance cost, which will be the interest expense, the interest charge. The interest charge will be, you take the effective interest rate, you multiply by the financial liability. Now, if you're looking at from the point of being a liability, the same element can be seen from the other side as an asset. Don't forget that. This one now we are looking at from the point of the issuer. We can talk about from the side of the lender. So from the side of the lender, what we are calling a finance cost or interest charge is an interest income. From the side of the lender, what we are referring to a financial liability is a financial asset. Now from that point, we now have to determine or prepare an amortization schedule. So we prepare an amortization schedule. In our amortization schedule, we'll have the year, we'll have the balances brought down, we'll have the interest expense, we have the installment, to be paid every year, which is at 10%. This is at 12%, the effective interest rate. And we have the balance carried down. That's the closing balance. This, let me put at 10% here, at 10%. Our figures are in M. Figures are in M, in millions. Fine. At the beginning, we start with the year one. Let me say the year one is the 2017, year two is the 2018, year three is the 2019. So we talk about the 5,000 million. What is the interest? I take my calculator and say the interest will be 12% by 5,000. So you come and say there is 600. How much should I pay every year? 500, 500. And maybe in the third year I should pay more because it's the final year, right? Should pay together with the principal. Then we come and say, so I'm looking at 500. If I say 5,000 plus the 600 minus the 500, I should have 5,100, and that's what I should begin with here. Then I recognize interest of 12% per annum, so this is 612. So I'll add 612 to 5,100 and subtract the 500. So this is 5,212. So I bring the 5,212. Then I say interest will be on 12%. That's 625. So I'll come and say 625. Then we have the 10%. And now being the final year, we may not only pay the 500. We may not only pay the 500, but we want to pay together with the interest, with the principal. Remember, they didn't tell us whether we are going to pay a premium. There is no premium, but in most cases there's a premium. So we are not going to pay with a premium. So we have the amount we are going to pay here should be 5,500. Let's confirm now. So we have 5,212 plus the 625. We have 5,000. So this one should be nil. There should be a difference, right? No problem. Now we need to recognize this as our finance costs. And this one we should be recognizing it as a liability. But because it's only 3 years, the first year, which is 5,100, will be reported as an uncurrent liability. But the second year, which is 5,212, will be reported as a current liability. So if you're looking at the financial statements, maybe we start with the profit or loss account. The profit or loss account. I'll have the 2017, the 2018, and the 2019. If you are to prepare, this is an extract. Let me have it and extract. So I'll have the finance costs. Our finance cost will be, this will be 600, this will be 612 M, this will be 625 million. That's perfect. Then we talk about the statement of financial position. Statement of financial position will also be an extract. It's not a complete one. Statement of financial position, extract, is also not a complete one. We have the 2017, 2018, 2019. That's it. Then we have non-current liabilities. In non-current liability, we have 10% loan note. It's a loan note, and 2017 is simply the 5,100. But the second year, it will not be a current liability. It will be a current liability because it is going to be settled in the next 12 months. Remember the difference between non-current and current. The difference between non-current and current is that the amount that will be paid within the next 12 months is a current liability. The amount that is falling due to be paid within the next 12 months is a current. But the amount that will be paid in the long run is a non-current. So in this case, the 5,100 would be paid in the third year. That's a non-current. But this 5212 is going to be paid in the third year because we are closing up the contract. So that becomes a current. So 10% loan note. So we don't recognize in 2017, but in 2018 is 5,212, but in 2019 we should not have any balance. So that's just an extract for the sake of a financial liability, which can also behave like a financial asset. If it was to be reported as an asset, then we could have an uncurrent asset of 5,100 and a current asset of 5,212. That is important. Now you need to also remember the basic journal entries. The basic journal entries. The basic journal entries that you should have entered for this kind of example. What you could have done, you could have known that there is, number one, you can recognize receipt, on receipt of cash, when the financial instrument was issued. When it was issued, what happened? We received the 5,000. So we debit our bank with the 5,000 million and credit our 10% loan note. 10% loan note, the 5,000 million. That is, we debit our bank account, we credit our 10% loan note with 5,000 with the net proceeds. Number two, we need to recognize the interest and even the repayments. The interest expense, which is actually our finance costs. What do you do with the finance costs? You need to debit our profit or loss or interest finance cost expense. You debit finance costs or the profit or loss account with the finance costs. I'm not putting everything there. Then we credit our 10% loan note. With the interest. So for interest for each year, we are going to debit our finance cost. We credit 10% loan note. Then you need to remember that we are going to make the repayments with the amount to be paid. We are going to debit our 10% loan note. Let me come to this side and say, three, with the repayments in each year, for each year, you are going to debit the 10% loan note. Then you credit your bank. With the amount paid. So that's what we should do when it comes to just basic financial liabilities in accordance to IS 32. Now, we'll want to look at another example further. When we talk of IS 32, there is what we refer to compound financial instruments. Compound financial instrument. So compound financial instruments. Compound financial instruments, friends, is a financial instrument or a contract that will give rise to a financial asset or financial liability that has are both the liability component and the equity component. This is a financial instrument that has a conversion option. Examples we can give for this kind of items is like convertible 10% loan note, convertible 20% debenture, convertible 15% redeemable. So it must be converted. That this financial instrument has been issued, yes, but it's likely to be converted into ordinary shares in the near future. So it has a conversion option. For compound financial instrument, IS32 requires that we need to separate them for presentation. We need to separate the liability component and the equity component, or the asset component and the equity component. So we need to separate those two items. So this is what we are saying, that they have a conversion option. They have a conversion option. A conversion option. They have both liability and equity components. Examples include maybe let me say X%. X%, I'm using X, it can 10, 20 like that, 15%. X% convertible loan note or loan stock or debentures or redeemable preference shares, etc. The key item here is it's convertible. So the other one was not convertible. So this is convertible. So we require to separate. A separation would be required. IS32 requires a separation of equity component and liability component. Now the issue is how. We are asking ourselves, how do we do this? How do we separate the two? You need to remember that when you talk of liability component is equal to the present value. The total present value should be the total present value. The total present value of all expected cash outflow. Then we also have the equity component. Equity component is the difference between the liability component and net proceeds on issue of the financial instruments. So that is how we should go about it. That to get the liability component, then the equity component, we must separate them. Once we have separated the liability and equity component, then the liability component will be amortized. We prepare an amortization, a schedule for that, while equity component will be recognized in our financial statements as an option, as a reserve until the options have been exercised. That's exactly what we should do for IS for compound financial instruments. Now remember, the scope of IS-32 should be applied in the presentation and disclosure of all types of financial instruments. Certain items are excluded, for example, subsidiaries, associates, joint ventures, pension and insurance contracts. Now we'll want to look at an example. Which has the compound, an example for compound financial instruments. We'll look at an example for compound financial instruments. This example, I believe this is our example 2 for financial instruments. ABC Limited issued a 4-year 6% 500 million shillings convertible debenture on 1st January 2017. The effective interest rate in the market for similar instruments is 12%. The 6% convertible debenture was issued at a discount of 3% and issue cost amounted to 2%. It will be redeemed at a premium of 5% above the par value. Required: A. Determine the net cash proceeds. B. Determine the liability and equity component. C. Journal entries on issue of the instrument. D. Determine the amounts to be recognized in the financial statements for the 4 years. Here now, from the required alone, the net proceeds for immediately when we issue this, what was the net proceeds? It means that we are going to take into account the par value, we subtract the discount, we subtract the issue expenses. Then we determine the liability and equity component. Simply this is what we have to do now. Then we are also going to look at the journal entries on issue. That's no problem. Then we are able to amortize, prepare an amortization schedule so that we can determine the amount to be reported in our financial statements for the 4 years. Now this is what we are going to do. We have been told A, the solution now. Solution A, cash, net cash proceeds. Net cash proceeds on issue. The net cash proceeds on issue, make it clearer, net cash proceeds on issue. The net cash proceeds on issue, we simply take the par value. What is our par value? Par value is a nominal face value. The par value is 500 million shillings, 500 million. Then we also less discount. Discount on issue. Our discount on issue is 3%. 3% on the 500 million. That one I'll take my calculator. I believe is around 15 by 500 million. That's 15 million. So I subtract that. I also less issue costs. Issue costs is 2% on the 500 million. How much would that be? 2% of 500, I believe, is 10. Is 10 million. So we subtract that. What will be our net proceeds? Our net proceeds will be 500. You subtract 25. Yeah, that's 475 million. No, that is 475 million as our net cash proceeds. So we have answered part A. If you were to determine part B now, part B, the equity and liability component. Equity and liability component. For equity and liability component, friends, equity and liability component, we'll want to identify our liability component first. You know, liability component is simply, the liability component is the total present value of all cash flows, to be paid, all cash flows to be paid out. And our equity component is the difference between the liability component and the net proceeds. So we know our equity component, equity option, is simply the difference between liability component. We subtract the net proceeds, the difference of that. What will be the present value of all the cash flows? What are the cash flows we are talking about? There is an annuity cash flows that we're going to pay every year based on annual cash flows, annual cash flows for 4 years will be the 6%, the coupon rate, 6% by 500 million. If I'm not wrong, that will be 30 million. Then what will be the terminal benefits, or the amount we are going to pay at the terminal amount we are going to pay, amount to be paid at the fourth year. The amount to be paid at the fourth year will be, the fourth year alone will be the 500 million plus the 500 million plus the premium. We have been told the premium of 5%. So 5% of the 500 million. So that makes it to be 525 million that we are going to pay in the final fourth year. So we'll want to look at those items, and we know that our effective interest rate is simply something to do with the 12%. There are two ways of going about it. We can just have a small schedule, or we'll easily get that. We'll just get it in an horizontal way that way. So liability component, our liability component will definitely be the annual cash flows is 30 million. So 30 million present value interest factor of an annuity, 12%, 4 years. Plus, there is that we are going to pay in at the fourth year. So 525 million by the present value interest factor, 12%, 4 years. So this is a single amount at the fourth year only, but the 30 million will reoccur every year for the 4 years, for each of the 4 years. So how do we go about that? Remember those formulas. If you remember very well, we need to, if you talk of present value interest factor of an annuity, 30% n years is simply 1 minus 1 plus r raised to n and divided by r. That is simple to get, you know. If we are talking about this, then we are saying 1 minus 1 plus 0.12, then 4 years divided by 0.12. That's simple. Then you remember the present value interest factor, r% n years. We are saying 1 plus r, and if you are saying about what we are doing now is simply 1 plus 0.12, then raised to what? 4 years. Simple, we can easily get that. So we are saying this is 1.12, this is 1 minus 1.12 raised to -1, -4. Then I divide that by 0.12. Then we have 3.0373, right? Then the other one will be 1.12 raised to negative what? Raised to -4. I'm getting this as 0.6355. So what will be the liability component? Liability component will be equal to, the liability component will be equal to 30 million by 3.0373 plus 525 million by 0.6355. So what do we have there? So we are saying 30 million by 3.0373 plus 525 million by 0.6355. So I'm getting a figure of 424,756, 500 shillings. That's what we're getting as the liability component. Now we get the equity option. To get the equity option will be the difference with the net proceeds, which is 475 million minus the 424,756, 500. So what are we getting there? So I'm saying 475 million, 424,756, 500. So we get it as 243, 500. That's our equity option. Now we do the next item, which was the journal entries. So part C, we do the journal entries. C, journal entries. Journal entries on issue, on initial recognition. So here we are going to debit our bank with the cash proceeds. We are receiving 475 million. Then we credit our 6% convertible debenture with the liability component, which is 424,756, 500. Then we are also going to credit our equity option. This is now a reserve equity option with that difference of 50, 243, 500. That's what we're going to do. And the narration is being the cash proceeds, on issue of 6% convertible debenture at a discount. That's what you should do. Now we look at part D now. The amount we are going to record in our financial statement. So in part D, amounts to be reported in the financial statements. Here we are now going to look at, first, we must do some workings. We must prepare an amortization schedule. We prepare an amortization schedule. Now in the amortization schedule, friends, we are going to take into account the convertible, the liability component. So the balance at the beginning, that's year 1, 2, 3, therefore this is 2017, 2018, 2019, and 2020. So we have the balance at the beginning as usual. We have the interest expense. The interest expense at what rate? The interest expense is at 12%. Then we have the amount paid. The amount paid every year as an installment is at what rate? 6%. And then we have the balance at the end. So the balance at the beginning is 424. There is 424, 756, 500. The interest definitely will be 12% on that. So we have 424, 756, 500 by 12%. By 12%. So we have 50, 970, 780. Perfect. That is the 12% on 424 million. Then now we get the amount paid every year. We are going to pay in the first year, we are going to pay 30 million. We are going to pay 30 million. We are going to pay 30 million. But in the fourth year, we'll not only pay 30 million, but we'll also pay 525 million. So in the fourth year, we are going to pay a total of 555 million. How does it come to? There is the 30 million that we are paying every year. There is the 30 million we are paying in 2017, 2018, 2019, and 2020. 30 million each year. Apart from that, there is also the principal or the par value, the original amount which was 500 million. Apart from the 500 million, there is the premium that we are required to pay a premium of 5% on redemption, which was at 5%. So if you take the par value and the premium, it was getting us 525 million that will be paid in the fourth year. Apart from paying 525 million in the fourth year, there is also the annual installment that we should pay of 30 million. So if you take 525 million plus 30 million, that makes it 555 million in the fourth year alone. Then we come and say, now this one should be nil regardless of the differences, small differences that we may have. So we come and say, we take 425, 756, 500, we add the 50, 970, 780, we subtract the 30 million. So I'm getting 445, 727, 280. So that's the figure I will bring here again. 445, 727, 280. Then I'll take into account the amount here to be paid. So I'll multiply that by 12% so that I can get the interest finance cost. This is increasing to 53, 487, 273.6. So I'll add back to 445, 727 and 280. Then I subtract the 30 million. So I'm getting 469. We have 469, 214, then 553, 553.6. That's the same figure I bring here, friends. I say 469, 214, 513.6. Then what will be the interest for that year? 12%. So I take 56. So I'll get 56 this time round. 746.4. Let me have it as 0.4. Then I add that back to 469, 214, 513.6. So I'll get that, then subtract 30 million. So I'm getting a figure of 495, 520, then 260, like that. Then I bring that figure here, 495, 520, 260. So I multiply by that by interest of 12%. So I'll get 59, 462, 431. So remember this figure should be here, yeah, because of this. So then we are going to have, you're going to add the 495, the 520, then we have the 260. Fine. The difference there should be a small difference of just of 17,000. So that is okay. Now from there we are going to have we are now going to have the extract. Let's look at the extract. How could they be reported in our financial statements? How could they be reported in a financial statement. So financial statements extract. Financial statement extract. We have A, we have the profit or loss account extract. Extract, the profit or loss account extract. Here we have the 2017, 2018, 2019, and 2020. What do we expect to report there? We are expecting to report the finance costs. Finance cost of how much? We expect to report finance cost of 970, right? 780. Then we're expecting in 2018 to recognize 53, 487, and 274. We also expect to report 56, 305, 305. Then we have 746. In final year, we expect to report 59, 462, and 431. So that's what we expected to do for profit or loss. For B, the statement of financial position extract. The statement of financial position extract. So what do we need to do in 2017 and 2018, 2019, and 2020? Of course, 2020 we should not be having any balance there. Now here we have, there is first under the finance buy. Under the finance buy, we have the capital and reserves. There is an equity option. Equity option. There is an equity option which was 5243. 5243, yeah, 500, which will be recognized the same constantly. 500, 50, 243, 500, 50, 243, 500 until it's exercised. Then we have the non-current liability. Non-current liability here, non-current liability, we have the 6% convertible debenture. Non-current liability in 2017. In 2017, we only have 2017 is 440, 445, 727, 280. In 2018, we have a liability of 469, 214, 553.6. But now in 2019 is a current liability because it's going to be paid in 2020. So current liability, we have a current liability. And the current liability here we have 6% convertible debenture. The current liability is in 2019, which will be 495, 520, and 260. So you realize that in 2020 you don't have a liability, but in 2017 and 2018 we have an uncurrent liabilities, but 2019 because it's going to be settled in 2020, so we don't have an uncurrent liability, but we have a current liability. That is what we must have said as far as the financial instrument, compound financial instrument is concerned. That's as far as compound financial instrument is concerned. Now, that means we come to the end of financial instruments. Now, friends, remember there is IAS 32, IAS 39, IFRS 9, and there is IFRS 7, which talks about disclosure. And that can be read in details not only from the standard itself, but even from the book that is going hand in hand with the, what we have been doing. So please, you can be able to get this, access this from the standards, or you can access this from the books or the materials provided and our previous videos. Thank you very much for being with me all along, and I wish you all the best in everything. So we'll meet next session. In our next session, friends, just doing a recap of what we are likely to do. In the next lesson, we are going to look at items like share-based payments. We are going to look at items like taxes. We are going to look at elements of employment benefits. So those are some of the items we'll be looking at, and then we'll be able to call it assets and liabilities. So thank you very much for this accompaniment you have given me. I wish you all the best.